Hello, everyone. We're back. We made it. Appreciate your guys' patience here. Let me make sure I get an audio check here. We'll get ready to. All right, guys. Appreciate your patience here. 15 minutes late. What's going on? Very unprofessional, right? Sorry about that. Was getting a mentorship video recorded here and it was 45 minutes in my flow state. So I figured, you know what, let's go ahead and keep grinding. And I appreciate you guys waiting patiently here. So let's go and get into it, guys. I hope you guys are all doing fantastic. Amy, hello, hello. Joe, happy Sunday to you, brother. Josh, am I missing something? Is he live yet? No, not missing anything, brother. I'm showing up late. Was getting the mentorship video here recorded about 45 minutes deep into that recording, so ran over a few minutes. Tyler, yeah, something came up. Usually on time. Yeah, usually I'm on time. I try to be, but today just really wanted to get that video and get it recorded. So appreciate your guys' patience. Thank you, Tyler. Samad, yeah, thanks for letting us know. Yeah, I wasn't gonna forget about you guys. Awesome. Creative Wall Printing. Hello. All right, guys. Let's go and get into it. We're here. We're back. We did not go live last week. I was out at a rainforest reserve. Very beautiful. Had a really good time. So appreciate you guys and all the good wishes there. But we are back to business this week, though. We didn't miss much on indices. We'll get into that in a moment. And we'll touch on dollar, bonds, talk about stocks. I'll talk about cryptocurrency. I'll talk about metals. And as usual, I'll take you guys' excellent questions. Joe, hello from Germany. Oh, awesome, Joe. Nice, man. Out traveling. Good, man. Enjoy it. Aslam, welcome back. I'm glad to be here. RT Money, my man. What's going on, brother? Glad to have you. Alrighty, let's go ahead and do it, guys. Tyler, glad to see you, my man. Love to see you killing it. Appreciate you sharing with everybody, man. Showing them what's possible with hard work and consistency. Love to see you, brother. All right, guys. So we're going to take this from the top here, monthly chart. And we're going to give you guys the lay of the land, what I'm looking at on a macro perspective. And then we'll work our way top down. Like I said, I'll cover all the different markets that are of interest right now. And I'll get into your guys' lovely questions. So let's go and get into it. So 3-month chart here for US dollar. Here's what I'm considering. We have this fair value gap here. So let me move this one here. We have this SIBI here. We traded into it. Partial entry into that fair value gap. That's an institutional wonderful entry, Joe. And it's occurring at this breaker here. We have a high, higher high, lowest down close candle, extend that through. We have a breaker block and institutional wonderful entry drill, which is a partial entry. If you're new here, what we look for inside these fair value gaps, the fair value gap itself is not just enough, right? So yes, this fair value gap here is great, but we're taking it one step further. We want to see how the market uses that fair value gap. The fact that it trades up into it and stays in the lower half, that's a signature that you're going to grow accustomed to learning, is indicating the market is very weak and it's very heavy. So whereas a lot of people were like, man, where'd that drop come from, last week? I'll get into what they are running for. They're running for the fund level stops on that daily chart, and I'll cover what that means and why that's so important. But this is how we're using fair value gaps. We're not just, okay, here's a random box on our chart, and we're going to look for some reaction off it. No, we measure the range, and then we see how it uses that range. And it's going to give you a great deal of precision based off what it communicates. So institutional wonderful entry drill simply means just a partial entry into a gap that doesn't reach 50%, and we have that breaker block here that's overlapped with it. So we hit that, closed weak, and now on this candle we open traded higher. Now we're seeing that swing high formation forming. So what I'm looking at for the remainder of this 3-month candle will be heavy distribution to the downside. Now this is further solidified with this 3-month inversion fair value gap when we see how the market trades up into it. But look at the bodies staying at the low of it here, and then it trades up, hits the lower quadrant, rolls over. That's telling you it's weak, it's bearish, it's heavy. What I would look for then as a draw on liquidity, if we do keep selling off, will be this low here on the 3-month chart, and then this potentially far down as these relatively lows here, if we really start to accelerate. And I'll talk about how we're likely going to see a measured move from this high to this low, and we're likely going to see this range duplicated to the downside. And I'll cover how I'm able to have that expectation on price. Again, doesn't mean it has to happen. This is just my initial thoughts going into the year. We're still in January, so still got plenty of time here this year, but these are just my initial thoughts going into the year based off the lay of the land at present. Which, as you guys know, with all the excitement, going on now, things can change very quickly over the weekend. So also keep in mind, we can gap hundreds of points or pips as it relates to Forex. So take my analysis here with a grain of salt, because with everything we're seeing, the gap risk is insane, right? Even last week, I was actually kind of glad I didn't go live, because then if you saw last week, we ended up gapping down here, over 200 points. So that does change the analysis, if we see a major gap like that. So just keep in mind that if we do see a major gap, you'll just have to get readjusted to the lay of the land. All right, so monthly chart, refining it down from the 3-month, right? So again, it's not taking me that long to do this. So, you know, you guys may be asking, well, Dylan, I mean, the 3-month chart, the monthly chart down to the hourly, I mean, is this taking me 4 hours to do your analysis? Not at all. It takes me actually more time to explain it than it does to actually do it. So I do this analysis in like 45 minutes, 30, 45 minutes. I put some music on, you're hanging out on my Sunday, drinking a cup of Joe, and I'm just here locked in on my chart. So it's nothing crazy. It's not taking me, 5 hours to do analysis. It's very simple. It may feel like it at first, especially if you're still like, it's taking you time to still like identify the levels. But because I've trained myself to do this over years, my eye just jumps to the key levels. I can see this breaker here. I annotate it. I can see the liquidity. I can see the breakaway gaps here. It's just easy for me to jump to those things. That's because I've been doing this for a while, and I'm doing the reps that I train those I work with to do, so that you can get really good at doing this. So it's not actually taking me 15 hours to do my analysis. It's actually very streamlined. So monthly chart here, looking at kind of the lay of the land here. We ran higher. We cleared these buy stops here. Strong breakdown. And now we have this lowest down close candle, which is our bearish breaker block, right? We have a high, higher high. I do have a futures, free futures beginning course that will be coming out over the next week or so. I don't want to give you guys a date. Exactly, you guys will get more information as my team gets closer to finalizing that. But you guys will have a free futures beginner course from me. So for those of you guys that may still be floundering with the concepts like, okay, well, breaker block, okay, what does that even mean? Or fair value gap, just simple basic things that will be covered in a beginner course, and also telling you guys everything you need to do. So you guys are actually gonna get the full blueprint that I give to those that I work with directly. So those that work with me directly, we get structure from day one. This is what you need to do. We build the trading plan together. We do all the things that lead to professionalism and consistency. And the good thing is I will be giving all that to you guys for free in our free course, which will be out, I think, in about a week or so. So don't hold me to that date. Like I said, I have to see when my team finishes it. But I will get that to you as soon as I can. So bearish breaker, last down close candle before the liquidity run. Send that through. We hit it once, hit it twice here. We sweat the stops inside that range, and now we're seeing a strong breakdown. So as of right now, this looks heavy, it looks weak, and it looks like for the rest of January, we're going to keep sinking into this low here. So bearish on the monthly chart. Keep in mind, if the market does remain weak, then we will be looking for these relative equal lows here, and the market will likely run down to those lows. Now, I told you guys about a measured move. What does that mean? So if I'm looking at this here, right? This is like the starting point of the price run. This is where I'm thinking it could go, right? It could go down to these lows here. It's like drawing liquidity. So beginning of the move, ending of the move. Look at where we're at here. We're at 50%. And if you look, it aligns with 50% of the implied dealing range, which is basically a range that isn't there yet that you expect to be delivered, right? So if you see here, we're consolidating at 50% of that. Usually when you see that, that's indicative that they're consolidating at 50%, and we're likely going to see another measured move down into that drawn liquidity. So if we really start to accelerate away from this consolidation here, then what I'll predict and anticipate will be a measured move from this high to this low, and just see that range duplicated to the downside. Weekly chart. So we talked about this bearish order block here in the last couple of weeks as our premium array. You can see we dug up into that in the last week, and then the week that we just had, market just opened and gave up the ghost to the downside, right? So weekly bearish order block, we stayed in the lower half of it here, and then we started sinking. So no surprise that we reversed from this premium right here, because the market traded up into a premium market. Why is that a premium market? Because if you split up the range from the high down to the low, it trades up above 50%, right? So concepts like this, right? Simple, basic concepts, dealing range, basic things will be taught also in the free course as well. So if this is kind of going over your head, don't worry, it won't very soon. So the market drives up into 50%, a premium market, and then it rolls over and attacks the low here. And then this low here that you'll see on the daily chart. So going forward, for us to remain bearish, we need to stay below this down close candle here. So like my premium levels for this week is going to be this this down close candle that's above market price. We need to stay below it. This is a mitigation block here in my analysis. And then for the levels below market price that are going to be of interest to me, it's going to be this large wick here, 50% of that. Also upper quadrant as well, but 50% is just the easy level. And then if we accelerate through the 50% here, my attention will be on this low here, and as far down to these relative equal lows here. So that's what we're looking at on dollar. Really, really good sign here, guys. Good sign in terms of for traders. We want to see movement, right? So the dollar being held up in this range here for almost a year now has just been absolutely brutal for Forex, for all markets really, because that intermarket analysis just hasn't really been there to a high degree as it is when it's trending and it's an expansion. So now that we really see this elephant jumping in the pool here, as good old ICT would describe it, that is really good because now this displacement and price action will bring in fund level order flow. That fund level order flow will then translate to beautiful price runs because what the market is running to is the fund level stops. You're going to think, well, the funds, they're profitable, right? They got the billions of dollars, right? Not necessarily, right? Remember, they're only trying to make 15 to 20% a year, right? What a lot of you guys are trying to do in a morning session. They're doing that in a year. So they can be wrong a lot and still do relatively well. And you got to think, to top it all off, these funds are not even managing their own money. They're managing other people's money. So they really don't even care all that much anyway. So saying that to say, what the market is running for on these higher time frames. Why am I bringing that up? Is it to pick on the funds now? It's so that you understand what these markets are reaching for. So as I drop down to the daily chart here, when you now look at the market through this lens here, let me take off the annotations here. What is below this low here and this low here? They're relatively equal. That's going to be fund level stops, right? So for funds that are long here, their stops are going to be here. One, they're not over leveraged and they're looking for long-term trends, right? That's how funds trade, right? They're not very high accuracy, but when they do get a big mover and a big trending run, they can absolutely bank on it and it fixes a lot of their low accuracy, their low strike rate. So the market is going after the fund order flow. So like, why do we see this big down drop here, right? Well, the news is going to tell you a whole bunch of reasons why it dropped on a fundamental basis, but I can tell you exactly what it's reaching for. There's stops here at this low here. And then if they're going to reach for these stops and really accelerate it lower, well, where's the next obvious pool of fund level stops here? Why the daily chart? Funds trade on weekly, monthly, weekly, daily, and hourly highs and lows. So hourly highs and lows, daily highs and lows are going to be the bullseyes for the fund level stops. And the market's going to gun there. And if you understand how the uninformed trader, because funds are still using retail logic, right? They're still using moving averages, you know, the crossovers, like they're not that advanced with what they're doing. So they're not very precise either. So their stops are going at obvious levels. So just like retail is trained to look at the market, like small retail traders, they're retail minded in how they trade. So their stops will be at obvious levels like this low here and this low here. And the market will gun for those stops. So with that in mind, now that you guys know like why daily highs, hourly highs and lows are so important, that's one factor. So look at this here. We have a high here. We have a higher high here, and we have the lowest down close candle. That is your breaker block. Extend that through. The market trades higher into a premium of this range high, this range low. So we trade up into a premium market, and then we hit this breaker. From here, we see a huge displacement lower. I'm going to show you this on the 12-hour chart here real quick. And now you guys can see this is just classic ICT 2022 model, right? Market rallies, clears the buy stops, displacement lower, fair value gap, hits it, and then rolls over for what? The fund level liquidity at this low here and this low here. And you see easy money. So when you start to look at the market through that lens, now you're not confused anymore. You're like, oh, well, what's it going to reach for? Why is it going to go down to that low and close perfectly there on Friday? Because it's going to engage that liquidity that's there, right? So it removes all the mystery. So let's go back up to that daily chart. So the breaker here took price lower. I'm going to take this off here. That was just to give you guys context to kind of what happened last week. Why did we drop from here? It's because of how we traded in a premium market inside that breaker, and it broke down. That's telling you it's weak. If it's weak, it's going to reach for fund level liquidity. So now we broke down. We have a bearish breaker block here. So for my premium arrays or levels that I would not want to see the market get above, for me to remain bearish will be this bearish breaker here. So this bearish breaker, we should not get above it. I don't want to see us get above this breaker. We can open early in the week, potentially retrace up into it, but it should not get above this breaker here if we're going to remain bearish. For my discount levels below market price, that would be a draw. Well, this low here, we already engaged. So the next draw would be this low here and this fair value gap here on the daily chart, just this little gap here. Through that, we have this level here, that 50%, which is 50% of that weekly wick. And then through that, we have the low here. Dylan, why is that low important? Again, fund level stops are going to be at these lows. So if they really accelerated down into that, that's going to allow them to consume that liquidity. Because again, that's actually what's happening here in the markets. The markets aren't actually after retail. Right? Retail just puts himself on the front lines as cannon fodder, right? What's actually happening here is the smart money is cannibalizing the funds because the funds are putting huge amounts of money in here. So that is what is actually happening, right? The smart money is actively cannibalizing the funds. And if the funds aren't allocating order flow, then you're not going to see a whole lot in the market, which is exactly why. Look at NASDAQ. All right, trash price action the whole month. Why? Because it's still in a range. There's been no big displacement for funds to start allocating their order flow into the market yet. So because they're not allocating that order flow to the market, it's just going to stay in these tight, choppy ranges until you see a displacement. And this is a displacement here. And then you can see it's running for obvious liquidity because now that dance is happening between smart money and the funds. So downside targets, fair value gap, wick, 50%, and then this low down here. Hourly chart here. Yeah, so very heavy. So the next chart would be these levels here on the daily chart that we covered. Like I said, it can open and potentially retrace higher, or it could very well just really slip and just aggressively start running for these lows here. So those are the two scenarios I'm watching. If it does retrace, I would expect this breaker here, this red rectangle, to stave off higher prices, and I want to see it roll over from there. However, keep in mind that this thing can really just keep accelerating if it really wants to keep running lower. All right, bonds. Bonds are still just been trash. So bonds are just still, consolidating here, which they won't be for long if we have military escalation in the Middle East. So something to consider. Weekly chart, same thing, just trash, choppy market. So yeah, there's nothing really to talk about in the bonds here. Watch the order flow on the daily chart. If I had to lean one direction, it would be bearish order flow on the daily chart. But because of the market structure, how this is delivering, I really wouldn't put a whole lot of emphasis behind it. All right, NASDAQ here. So I want to show you guys that example as to when the fund level order flow and the fund level stops are being attacked, how different the price action is in an asset where that is happening, and then how different it is when it's still waiting to happen, right? Because we haven't seen that displacement in price action yet. So let's go up to our monthly chart here. Looking forward to the course, Dylan. Thank you. Yes, sir, Savannah. Yeah, put a lot of effort into it with the team, so it'll be worth it, my man. All right, so looking at the monthly chart here. So if you've been struggling with indices or trading them overall, let me get into a little bit of why that is so that for the next time, you can be aware, you can prepare for it, and potentially manage it better. Looking at the month of January here so far, very similar to what we saw here in December. And for those of you guys that traded December, outside of scalping, it was a pretty difficult month in terms of sustained directional price movement. But if you look at what December was an inside month, meaning we didn't take out November's high or November's low. We actually anticipated that. Or we allowed for that to happen because of the seasonal expectancies, right? Well, if you look at January, it's done the same thing. It's exhibiting the same characteristics. It hasn't broke the previous candle's high or the previous candle's low. What this means on the lower time frame is a consolidation market profile. That's why trading is more difficult right now, right? It's not giving these easy sustained price runs. Now, difficult trading doesn't mean impossible. I'm still very consistent on this month, and it's been a very decent month for me. However, because we're in this range, I'm very risk averse. I'm trading low size, I'm trading very low frequency, and I'm managing the expectations because of where we're at inside this range here. I only learned this going through it. So don't think like, oh, if you had a difficult time here this month, it means you're a shit trader and you should have seen it. That's not the case at all. I got blistered a lot of times in consolidation before I really learned what's going on. So use this to learn because consolidations will happen again in the future. The only difference is how well you manage it. So how am I managing it? I'm sizing down. I'm not even trading a whole lot. I am still going live because I was weighing out a couple of things. So I was like, okay, I can just wait for this thing to leave the range, or I can still live trade with my group. And that's what I've been doing because I think it's still also very important for someone to see me hitting licks on the market, but also me taking hits and how to take those hits, how to absorb them, and how to not let it completely blow you out of control. So I still have been going live. I've still been not my most activity in the markets, but I still have been going at it fairly decently just because it's very helpful to see these different market conditions, work with somebody who can walk you through it, show you how to expect it, how to anticipate it, and more importantly, how to manage it well. So that's where we're at on December. December and January. Don't blow all your powder before the easy price action comes. Just take it easy, take it light, relax, right? Because better price action is going to come. But I also do understand, right? Because you always see everywhere in the trading industry, got to be patient, right? Got to be disciplined. But if you don't even know what you're waiting for, how are you going to be disciplined? How are you going to be patient if you don't even know what you're being patient for? What you're being patient for is the market to leave this range. Take out December's high or December's low. Once it does that, it's on. But until we do that, it's still going to be difficult. It's going to be choppy. It's not going to give you sustained price runs. So you really have to know what you're doing. All right, so let's work down into the monthly here. The weekly chart. All right, so looking at the weekly chart here again, the weekly is just as atrocious as this monthly chart. So we're still just banging around inside the range here. Now, what makes this more difficult? Well, if you look at this here, and you'll really see it on the daily chart, where's the obvious market structure? Where's the obvious order flow in this? Where's the obvious inefficiencies that it's going to draw to, liquidity pools it's going to draw to? Where is that inside this price action here? It's non-existent. So that's why the precision elements aren't there, because you may be thinking, oh, but we're scalpers. We're trading a 1 and 5 minute chart. You know, it's moving. Yes, that may be true, but the higher time frame price delivery will reflect in the lower time frames. That's what price is fractal means. The lower time frame is only doing what the higher time frame is doing. So if the higher time frame is in a consolidation and price is fractal, that will reflect in those lower time frames in the form of consolidation, chop, high resistance liquidity runs, because it's not actively trying to go anywhere in a hurry on those higher time frames. So what you have to understand is the weekly and the daily chart, you want those to be in trending expansion markets and profiles, because that's what's going to give you the easy lower time frame trading. So now hopefully you understand kind of what you're waiting for, why you are being patient, and why you're not trying to blow your whole stack here before we even get into the easy price action, easy trading days. So hopefully that makes sense. Looking at the weekly chart though, just now that I communicated that, I'm still watching this down close candle here. We're still staying above it, you know, on a closing basis. So if we do rally, these relative equal highs here would be interesting. We're still working off this down close here, but again, it's just, no, we're not getting any juice off that level. I mean, it's not hitting it and really running away. It's just chopping inside of it. And then for those of you guys that understand what we've taught as it relates to high versus low resistance liquidity runs, you can see this is very synonymous with a high resistance liquidity run signature. It's a lot of overlapping price action, right? Not a lot of inefficiencies being created, and it's just overlapping the same range. So when you see that on the higher time frame, that's a high resistance liquidity run or a consolidation market profile. All right, so last week, again, we opened down with this big gap here, this big gap down here. And then you can see we worked back up into it. As long as we remain, now so you guys can see, I showed you guys the range on the monthly chart that we're stuck in, but I want to show you guys here on the daily chart. Once we break this range high, this range low, price action will clean up. As long as we remain inside of it here, it's going to remain messy. Now, just because it's messy, it doesn't mean it's impossible. What you do when the market's in a consolidation, or what I do rather, is I'll grade that range. And then what I'll expect is the market to gyrate from premium to discount. So you'll see the market will, once the range is established here, right, it'll run to premium, to discount, premium, discount, back up to premium. So in a consolidation, there's still a rhyme and reason to what it's doing. It's not just, you know, still randomly gyrating. It may feel like that, right, because it's not as precise, it's not as clean movements, but that's essentially all it's doing in a consolidation. So if you want to understand the consolidation, how to work with it, then that's what it's doing. It's just going to gyrate from premium to discount inside the defined range. Well, why is this the defined range? Because this is an intermediate term high and intermediate term low that we're working with and that we haven't broke. So two things to take away there: how to understand the consolidation, but secondary is what we're also waiting for price action to clean up, which is to break either the range high or the range low. So hopefully that removes all the mystery as to kind of what you should be waiting for, what you should be waiting for to allocate more risk to the market, because this is what every unprofitable retail trader is doing, right? It's January. My New Year's resolution is to make a lot of money trading. So I'm going to go real hard in January. And, you know, as you can see, that's probably not the best idea. So you want to adopt the mindset of patience, but also more importantly, you want to know what you're waiting for. And that's essentially all it is right there. So here's what we're looking at going forward. Daily chart, equal highs, we have equal lows. So what's the draw? I have no idea. I have no idea what it's going to draw to. Now, what I'm going to use to determine what they're going to draw to is this gap here. So if we get above this midweek opening gap, start to work higher, then my attention will jump to these buy stops here. However, if we start to work down through this level here and start to lose it to the downside, then I would look for these relative equal lows here. So, right, not very helpful because it's both sides of the market, but it's also very important to understand that there are times when the higher time frame isn't clear. And what you have to be comfortable with is waiting for more information, right? You don't want to be an action hound who has to take a trade. You want everything to be in alignment for you, right? You want high probability, and high probability comes when you have that time frame alignment top down. And as of right now, that daily chart just is not clear, which is what's causing a lot of this atrocious lower time frame price action. And now looking at the 4-hour chart here, really want to show you guys this here. If you look at the 4-hour time frame here, last week, look at the delivery. We created zero, let me see, let's make sure I'm saying that right. Yeah. Zero fair value gaps are created on a 4-hour chart. That's why your lower time frame is trash. There's no displacements. There's no clear, obvious inefficiencies for it to displace away from, come back into, fill the upper half, quickly leave it, run to the opposing liquidity. There's none of that. So that's why your 5, 15, and 1 minute charts look like trash, because the higher time frame is doing that as well. And let me contrast that with cleaner price action, right? This is what I mean by obvious price action. When you can see clear displacement, clear gaps, it drops into the gaps, it uses it as support, you see the body stay in the upper half. So guess what? That's easy money to these equal highs here. Bam. Fair value gap, down close candles, hits it, reaches higher for the obvious liquidity, and it's like a trending market, right? This is clear, obvious market structure to work with, right? This is not that. Right? So hopefully you guys can see the distinction there. And also, by contrast, what you're looking for, right? What you're trying to trade, and also what you're not trying to trade. So I want to talk about the 4-hour chart there. We did, yeah. So again, this new week opening gap here is going to be of interest, and we're finding this down to the 1-hour chart. So looking at the 1 hour here, they took it higher, they cleared these highs here, and they left these equal lows here. So for those of you guys that are in the Discord, I haven't been sharing much pre-market analysis. And the reason being is because going into 9:30, I'm not entirely sure what the draw liquidity is, right? If the daily and the hourly chart's clear, and then it's easy for me to go on there and say, all right, guys, look, this hourly fair value gap, we're going to see it shoot lower from here. These equal lows here are the draw. And then you already know what I'm looking for at 9:30, a manipulation, and I'm shorting that first gap that forms off it, right? Easy money. We just don't have that right now. So I'm not sharing as much analysis because my visibility is also limited. Now, that doesn't mean we can't still go in here and find setups, because post 9:30, I can still determine institutional order flow with the draw, and then I can wait for that one-sidedness to come into the market, but it does require a lot more focus. It's a lot more demanding, and I'm even more likely to get stopped out in these types of conditions here where it delivers like this. So what I'm looking at here is we took out these relative equal highs here on the hourly chart. We're starting to break down through these highs. So these relative equal lows here would be a clean draw if we start to really break down and reject these highs here. Outside of that, though, again, my visibility is very, very limited here. Let's go over to S&P here real quick. I do want to touch on S&P to kind of complement the analysis here with NASDAQ. So while NASDAQ has been stuck in the range, S&P hasn't as much. S&P left the range and actually cleared all-time highs. And then we saw a breakdown here. So what I'm watching in the ES is how we use this gap. So same thing I'm watching in NASDAQ, I'm watching in the S&P. This gap here that we're trading within. So far, this thing looks weak. We traded up into it. Market stayed in the lower half with the bodies, and we couldn't even fill into the high of the gap. So if we start to work lower from here, I will see this as a bearish beginning of a sell model, because now we have the high taken here. We have a displacement through the swing low, and now we have the gap that we're trading into. So if we respect this gap and start to work lower, then in my mind, that would be very bearish, take us into this low here, then as far down to these lows and these lows here that are relatively equal. But that's only if we stay below this gap here. Because we're in a consolidation, I don't know what they're going to do with the gap, right? If it was more clear, we had obvious order flow and maybe the monthly, weekly, and the daily, then I would give you something that's a lot more one-sided, that yes, I want to see the market sell off from here. And that's what I will be actively looking for. Right now, I just don't have that clarity because of where we're at in the overall grand scheme of things. I do think in February, things will clean up. And obviously with all the geopolitical things going on right now, that'll probably also bring a lot of volatility into the stock market. So just some things to consider here going forward. So touched on the hourly, we'll go down to the 15-minute chart here. So again, if we start to reject and we don't get above this 15-minute gap here, then these relative equal lows here are going to be my draw here. And then as far down as to these relative equal lows. And then from there, I'll just have to get a lay of the land and kind of see where we're at. I will be updating throughout the week though. So if you're not in the free Discord, do join. I will be updating you guys throughout the week as to what I'm looking for, what my analysis may be calling for, if I have to pivot or adjust throughout the week. Hey Yoda, ciao from Italy. Oh, nice, shout out to the Italians. I have quite a few of you guys here. Note, so until we take out December high or low, we'll likely have to relax, be patient, and wait for the market to tip its hand. Yes, sir, absolutely. All right, guys, so cryptocurrency, gold, the $1 million question. For cryptocurrency, guys, I wouldn't hold your breath. I wouldn't hold your breath at all. We've been calling this market lower, and with good reason. So let's check this out here. Isn't it cool being in the know? I wasn't for a long time, so it's good to be now. All right, so look at this here. Bitcoin, bearish, right? Displacement candle on the monthly chart. So like I tell you guys, right, we're not just putting random gaps on our chart and, you know, hoping for some type of reaction there, right? We know exactly what we're looking for. So we have what? A monthly fair value gap here. It's the same thing I'm doing across every market, with dollar, every market. So we have a gap here, and now we measure that gap, right? And then we get the, and then we get these quadrant levels on it. So If the market's going to be bearish, well, what should it do inside this hourly gap? We should probably hit it, right? And then ideally stay in the lower half. So there's nothing remotely bullish in cryptocurrency right now. And if you're seeing something bullish, I don't know what chart you're looking at, because there's nothing bullish in cryptocurrency right now. We broke down fair value gap here. We're trading back up into it. Now, what the 2022 model is designed to do, which is, this is not the 2022 model technically because there's no like short-term low here, but it's still the same idea. And what's happening here in the retail mind is retail sees a drop, right? They're probably still holding onto their bags because they're emotionally attached to them. And then they're going to see it open here, right? At 86K on this month. And then they're going to see it pump higher all the way up into the 97s. We see this as, okay, it's the fair value gap. It's going to retrace up into that gap, and then we're going to see how it uses it and expect it to go lower, right? But what retail is saying, they don't understand that. So they see this thing at the 86s, and they're like, oh my God, 97s. It's going to 100. It's going to all-time highs. I need to buy. And all it's doing is retracing up to that gap to continue going lower. So you can see the difference in the smart money perspective and retail Rick, who's impulsively trying to trade these markets, right? So as it's pumping higher here, retail's getting all excited. Oh my God, the next bull run, right? When it's just going up there for smart money to sell into this fair value gap. They keep going lower. And the fact that it stays in the lower half, that's just a nail in the coffin. That, hey, look, this thing is weak, it's heavy, it's going lower. I'm not gonna look at any other the currencies because they're all gonna follow Bitcoin. So Bitcoin's gonna crater, they're all gonna go lower and follow suit. So hopefully that makes sense. Don't want you guys looking at the charts, not knowing what you're looking at. That's no fun. Now looking at the weekly chart, right, because we refine it top down, we see 3 drives pattern at the highs here. So this is heavy distribution. So when retail seeing, oh my God, it's at 100K, Bitcoin's going to 1 million now, their smart money's doing what? Distributing, and distributing some more to the retail that wants to buy the breakout at all-time highs, because now Bitcoin's going higher, right? Breakdown, shift in market structure here. This is actually a break in market structure. And then we retrace here. Here you can see the 2022 model more clearly, right? Low, displace through, fair value gap. It's going to trade up into that gap. And it should respect it, right? So as it's trading higher here, I'm seeing Twitter, I'm seeing the so-called cryptocurrency experts, load up your bags, boys, we're going up. And I'm watching it trade into this weekly fair value gap, thinking, what do you see in here? And then if you further refine this inversion fair value gap for more precision here, this gap here was used on the buy side of the curve, right? So they use this fair value gap to buy, send it higher. What's going to be used as an inversion fair value gap on the sell side of the curve. So when I see it, whoops, let me do all intervals, that's good. So on the weekly chart, when I see that inversion fair value gap and we trade up into it and we hit the low of it and we turn on a dime there, when this week opens, that's actually about to close, this is not bullish, right? It hitting this inversion fair value gap, repelling lower and closing off the low like that, that's not bullish. That's telling me the next weekly candle is going to open and drop. And now we have sell side here at the 80s and then sell side here at the 74s. And again, nothing remotely bullish about cryptocurrency. We saw heavy distribution here. And now we're on the sell side of the curve. So crypto experts, hopefully that makes sense. That's what I'm looking at. Again, I can obviously be wrong, but we've been nailing cryptocurrency here. So now we're finding it to the daily chart. Now you see, wow, the daily chart takes on whole new meaning when I understand what that monthly and that weekly is doing. Welcome to knowing what you're looking at. So looking at the daily chart here, early in the year, they pump it higher. And they clear out these equal highs. Man, so now retail's really long because they see it pump fast. They see it break out on these highs. So they're seeing what? Man, my double top just broke. Resistance broken. This thing is bullish. We're on blast off mode. It's going higher. When all it's doing is taking the stops, breaking down, shifting market structure. Here, that's your shifted market structure. And now this is also what? Your bearish breaker block, right? High. Let's make this a different color here. We have a high, higher high, lowest down close candle. Breaker with a fair value gap, hits it, crypto selling off. We're not surprised. Sell side here. So cryptocurrency, there's a more detailed breakdown than I usually do, but figured I would share with you guys kind of what we're looking at here. So crypto is going lower, and then that will, like I said, reflect in the other coins as well. Like you'll see Ethereum's gonna be bleeding out. And I think Ethereum's even weaker. Yeah, So here's SMT divergence, here's how you actually use it. You have to know the direction you're looking for, which is bearish. And then if you see SMT confirming it, it's super helpful, right? So we see here, Ethereum did not take out this high when Bitcoin did take out that high, right? So that's the SMT divergence. If you know what you're looking for, then you see SMT, it's super helpful. But by itself, SMTs, in my opinion, isn't all that precise. If you know what you're looking for, it's a great confirmation tool. So then there was the SMT, which is kind of like a nail in the coffin. If you already know what you're looking for, like I outlined here, and then you see an SMT divergence, easy money, easy ass money. All right, so it's crypto. So they're going to keep sinking, and metals are going to keep ripping. So let's get into the metals market here. And I shared, well, I actually shared this with you guys, I think like a few months ago, but we have been raging bulls on the metals market. There is nothing remotely bearish about metals. I'm seeing all types of stuff saying, you know, the metals are topping out. Metals aren't going. I love seeing narratives like that because this tells me it's going to keep going higher. So Bitcoin or gold, 5K, insane, insane. Now cryptocurrency, if it's what it was made out to be, cryptocurrency should be ripping higher right now. The currency is being devalued at a pace you've never seen before. The geopolitical uncertainty is out of this world. So if crypto was this big safe haven asset that's going to protect you from inflation and you know all this great stuff, like it was promoted to be, like I thought it was at once as well, then it should be performing like this right now, but it's not. So the metals is the opportunity, and in my opinion, the cryptocurrency is a distraction so that people put their wealth in the crypto and not the really real shit, the metals. So we're going to see keep seeing gold surge likely. Again, and not that it can't have volatility, right? I'm not saying like this thing's just going to keep going straight up. They can absolutely rip this thing lower. In my opinion, that's a buying, not financial advice. That's a buying opportunity. So if they do give a discount to gold or silver, that's an amazing buying opportunity. It's not a means of like thinking, oh, they're going to price at the top and we're never going to see it again. Because if you understand the driver behind this market, it's a no-brainer. It's a no-brainer, and I covered that at length in the education channel in our Discord. If you're not there, I don't know what you're doing. So make sure you're in there, you're looking at the education channel, because I'm literally telling you what's going to happen and why. All right, going over to silver. What a move, huh? I wonder who saw that coming. I don't know who was talking about silver in the hundreds. Some crackpot on YouTube. So silver's mooning 103. Beautiful, beautiful price run. We haven't seen anything yet. Like I said, there can still be short-term volatility. They can, you know, sink it lower in the short term, but I think longer term, silver and metals are going much, much, much higher as they start reaching fair valuation for them. The metals have been suppressed for years. How did they suppress the metals? Well, all these markets are rigged, as you know. That's how I'm able to do this, right? Because if it wasn't rigged, you know, and it was really just random buying and selling pressure, then, you know, we'd be clueless here, right? But the metals market is extremely undervalued because what's actually being traded is not the physical metal, right? It's paper contracts. So what JP Morgan can do, which they've gotten fined for numerous times, right? Because they're all criminals in suits. They will just spoof it. So they'll spoof the market, and what they can do is they can dump paper contracts onto the market and make it look like there's more supply than there really is. So if you understand that what we've been seeing in metals has not been the real price valuation of it, they've been artificially suppressing metals and holding them down. For what? For them to accumulate these discounted prices. Well, why would they want to accumulate these discount prices? Well, now you see why. And smart money is anticipating this down here, not up here. Yeah, so they suppress the market through the paper contracts, through the paper derivatives, where they can just create as much paper derivatives as they want, thus manipulating the price, right? So what you've been seeing has not been real price discovery for the metals market. What you are seeing is now that fair value rush into the market because now they're allowing it to go to its real valuation, which we haven't seen anything yet. So there's the insight on metals there. No surprise there. And I think that's it. Crypto, metals. Any questions for me, guys, here before we get going? I think that's it. I think we're good with that here. Yeah, that's good. All right, guys, any questions for me here before we bounce on out of here? RT, so sometimes you mark your fair value gap at the bodies versus the wicks. Can you give us your thinking behind this? Example, IFEG on the daily time frame. DXY daily time frame? Yes, sir. Let's take a look at it. So I'll go in, I don't know what example you're referring to on the daily chart, so that's fine. I'll just go to an example that has what we're looking for here. So let's go to NASDAQ and yeah, perfect. Here's a great example here. All right, so we'll zoom in here and I'll give you a detailed answer here. And so this applies to all time frames. Yes, it's a 5-minute chart on NASDAQ, but it applies to the monthly on dollar, the weekly, daily, and any asset. So when you're looking at the fair value gap here, in this example here, I would not make the fair value gap from here to here, right? Because there's that volume imbalance there. So whenever you see that volume imbalance, I'm not going to draw it from wick to wick. I'm going to draw it from wick to body, because now that'll give me a truer depiction of the inefficiency. Now, if you have an example like this, where here you can see there's no volume imbalance, and then here there's no volume imbalance. If that's the case, then I'll do it wick to wick and then use this there. But if there was like a volume imbalance here, like it was here, then I would have to extend it up to the bodies there to just capture that true inefficiency. But in this case, that wouldn't be the case. So 2 examples here just on the 5-minute chart with NASDAQ, and that's how you draw the correct fair value gap. So if it has a volume imbalance, you have to encompass it. And then if there's a volume imbalance on both sides, which I think this example has now. Yeah, well, if there's a volume imbalance on both sides, like at the high and the low, then you want to incorporate both of those into your full measurement of the fair value gap. And that applies to all time frames. So any time frame I'm looking at, if it has volume imbalance, no matter how small it is, even if it's 1 tick, the algorithm will refer to that. So you want to make sure you're including that in your correct drawing of the fair value gap. Here's another good example here. Right? You may just think like this is the gap here from this wick to this wick, and sure, that'll work, right? You know, still get what you're looking for, but just have the true inefficiency, you have to bring it down to the volume imbalance there. And here's a good example here. Perfect. So this, you see this fair value gap here, and you see how it has the volume imbalance here and here. So you would want to include both of those in your measurement of the fair value gap. And you can see how it gives you more precision when you draw the fair value gap correctly. Great question, sir. Amy, ICT shared this past Friday that silver has gone above 101. If you have been with me for any length of time, you know I said this was coming. Now taking some profits here would be uncivilized. Yes, I did see his comment. Absolutely. Yeah, which makes sense, right? Because if you have been in the know, right, as to what these markets are doing, and you've been buying like I have 2023 or ICT, like he's been, I don't really know because I wasn't in private mentorship with ICT in 2016 and all these years here. So I did know like he was bullish metals, but to the extent and what he talked about, I don't really know because I wasn't in his paid circle. However, I do know he was somewhat bullish on metals. So what he's saying here is, if smart money entered down here, where would smart money start profit taking? Probably up here, right? When the masses want to all start getting into it, right? This market making 101. So that's what he's saying there. So taking on profits here would be lunacy if you got long down here, right? So that's all he's saying there. Do you see silver dropping in the near term? Standing in front of something like this is super tough. So absolutely. I mean, would I personally like want to co-sign anything bearish on a market like this? Absolutely not, because it'll just keep ripping everybody's face off and keep going higher. So can it retrace in the short term? Absolutely. How would you manage that though? You would already be in profit now. So now it's a win-win situation because you are long from down here or anywhere in here, right, at a cheap price, and now you're taking some profit. So now what can you do with that? You can bank some profit. You can roll the stock to break even, and then you don't care what it does from here. This is when retail is trying to trade the market. Retail wants to trade the market after there's a big explosive run higher, and now they're trying to determine, okay, there was a big move. Now should I long or short it? That's not really what you want to do. You should already be positioned from down here, scaling out profits. So if it does retrace in the short term, it's fine. You already paid yourself and your stops rolled. And if it just keeps running parabolically, which it very well can, then you're already long from down here and you're positioned anyway. So that would really be the answer. It wouldn't be to try to do anything up here, in my opinion, because you don't want to short the freight train, but you also don't want to buy at these ridiculous levels after it's already rallied. So it just comes down to opportunity is there when it's early. Once the opportunity is already manifested, now the opportunity is not really there. And then now this is when retail wants to get involved. And that's why the market efficiency paradigm works the way it does, because smart money went long down here. And now they're selling up here to all the impulsive retail buyers that now want to get into metals because, oh, look, it's moving. So guess what? I should probably take advantage of this opportunity. So there's market making 101 for you. and how you want to internalize the market. So you don't want to think like a retail trader who wants to see the big run, and now it's time for me to do something. You got to predict the big runs. Euro dollar, yeah, I'll touch on euro. So it's really just going to be the inverse of what we talked about here with the dollar. So yeah, it's really going to be the same thing here. Watching this bullish breaker here, we have a low, lower low. So this highest up close here is a bullish breaker block. And then the next draw for me will probably be the rejection block here, which is just the highest body. And then through that, we have the high here. So this high, this rejection block, that's my upside targets for euro. What would change that is if we get below, if we get below this candle's low here. So if we, it's basically this down close candle. So if we lose this down close candle here, then that puts bullishness on the back burner. And that's what I'm looking at here for euro. All right, guys, I'll take a couple more questions here. Then I got to get going here. I've been recording here for about a couple hours straight, so I'm going to go ahead and get on out of here. So NQ is neutral until we leave the range correct. Yes, sir. It's a scalper's market, which means you have to know what you're looking for, surgical strikes, but higher time frame macro perspective is absolutely neutral. There's nothing I can say with a great deal of confidence higher or lower in the current range, and that's a superpower to know that as well. So that's why I want to show you guys that, because people that are always trying to sound like they always have it figured out, they always know what the market's doing, that's actually doing you a huge disservice. Because as a trader, there's going to be times when you don't know, and you have to be okay with that. Because there's going to be times when you have to wait for more information because it's just not clear, and there's absolutely nothing wrong with that. What is your analysis for oil? Let's take a look at oil. Probably very bullish if we see a continuation of what's going on right now. So oil has just been a ranging market for a long time. So oil's been a sleeper. So kind of like I've been talking about with NASDAQ on the daily chart. Now, what does crude oil look like on the monthly chart? Same thing we talked about on NASDAQ, trash market. I can make a case for the highs, I can make a case for the lows, and just banging around inside that range. So it will be very low probability in the short term until we leave that range. However, on the geopolitical front, we could see, if we see a lot of escalation with what's going on the geopolitical side, then we could see crude oil absolutely start ripping higher, kind of like what we're seeing in the metals market. So that's nothing technical based. That's purely fundamental based off world events and kind of how things are unfolding. So on the technical side, there's nothing speaking to me in this market structure, in this order flow. But from a geopolitical standpoint, war is very bullish for oil. So if we do see escalations of wars and countries attacking and, countries closing down their airspace or Americans being evacuated from certain countries because, shit's about to go down, those are all things that are going to have a lot of ramifications in the oil market, and it will be bullish for oil. Islam ICT mentioned that an indecisive close on the candle doesn't count, and you can include that number 4 for the whole fair value gap. Any idea about that? Yeah, I see what you're saying. Yeah, if there's an indecisive candle, just not using that candle, kind of disregarding it in your analysis and using the candle before it. Yeah, absolutely. Yeah, that works. And that would just be more of a refinement, right? So if you wanted to refine the fair value gap even more so, then that would be something you would include. Absolutely. I think he's rolling out a lot of more technicalities, more rules, more specifics, I think, in present. So any new technicalities that he shares, then I'll welcome them. But I think it's just more so going to be a refinement of how to measure and calibrate the ranges. So I think you'll be fine measuring it traditionally, but like I said, if he's going to make more information available in terms of refinement, then I think that's awesome. So that's what I think about that. Joe, thanks, Dylan. Sorry about no trip, just present times. Oh, I got you. No, sounds good. Hey, Joe, reach out to me, brother. We'll be in touch, man. I know you're making arrangements there on your end, and I know you've been working for a while, so definitely would be good to catch up, man. Tyler, probably see 2 small daily down close candles as continuation on silver. Yeah, absolutely, definitely. So looking at silver, very well could be. It's just it's such a difficult position when a market's ripping parabolically, because you don't want to be the guy calling the top, right? That's no fun. But it's also very overextended. So we're seeing something we've never seen before. So this is unprecedented times. You're just seeing currency devaluation real time. And this is the first time this happened in America. So it'll be very interesting to see what happens here with this. So absolutely. So very tough to short silver, but keep trusting buy models, just like we do in indices, right? When indices are at all-time highs, you just keep trusting buy models, looking for higher prices. that would be my recommendation on silver, right? I mean, you don't want to be the guy here the last, 2 years that's trying to short this market, thinking the tops in every retracement. So that would be my suggestion for silver for those of you guys that are asking. Keep trusting buy models, looking for higher prices. If I was trading this market, that's what I'd be doing. Yes, sir. Thanks. Awesome. Yeah, we'll be in touch, Joe. Alrighty, guys. Appreciate you joining us here today. Again, apologize for showing up a few minutes late. I'll do my best to be a little more professional here next time, so I'll give you guys all your money back for this one. With that being said, guys, have a good rest of your weekend. I will see you guys on the next one. I'm sure we'll do some more lives, especially since I'm taking it lighter in my trading this month. I'm sure I'll be live with you guys on YouTube one of these days. So be on the lookout for that. And other than that, guys, I will see you guys on the next one. Take care. Have a great weekend and stay safe, everybody. Take care. Later, Aslam. See you, Joe. Later, Tyler. Bye, guys. Later, Josh.